Buongiorno! Market update of October, financial market first and real estate market second. So stay online and listen to it until the end. We have a lot of news to tell you. So let's look at this chart. We have reached the last quarter of the year so far. S&P 500 is up 21.2% year to date. Nasdaq is at 21.9 and the Dow Jones is at 12.3 and the Russell 2000 index 9.84 respectively. So a good quarter. We did see a 4% pullback in the month of September, but the market bounced back up swiftly and managed to close and move and end up the month positively. So the S&P 500, as you can see, is still in uptrend, continues strong in an uptrend. So in this chart, I can show you that the uptrend is confirmed. Short-term uptrend and medium and long-term uptrend is confirmed, where we have the 200 moving average sloping up nicely and continue to go towards the end of this year. So 200 moving average up, 150, 150, 40 and 20 EMA up, and all of them sloping up. So this confirmed the uptrend. On the 18th of September, the Federal Reserve finally cuts Fed fund rate by 50 basis points, 0.5%. Everybody talk about it. We talked about it before. A real estate agent, they couldn't wait for it. So we brought down the target range from 5.25 to 4.75. This was the first cut rate in 4.5 years and the start of the Fed new monetary easing cycle. Based on the minutes and the Fed dot plot rate, Fed member expected a rate cut of 0.25. Instead, it went at 0.5. So this was much more than expected. If we see the page, the slide after, here we see the Fed who anticipated 2 more cut rates by the end of this year. This is the Fed dot plot rate. So all the members are those dots and they see what they expected to be at by the end of the year. Here, so no one can really predict for certain if the economy will continue to stay resilient over the next 12 months. So, however, based on the latest economic data, it looks like the second scenario is more likely the one where the Fed's cut rate because they wanted to adjust interest rate, not because we are going to a recession. So the US economy continued to grow with an inflation tracking down towards the 2%. Finally, we're coming back to the 2% inflation rates. Second quarter GDP pre-accelerated at 3% and third GDP is now tracking at 2.5%. On Friday, the US economy reported adding another 254,000 jobs in September, and this is way much above expectation, a nice rebound from 159,000 in August. So we have 100,000 more. So the unemployment rate came down at 4.1%, down from 4.2 in August and to 4.1 now. And the inflation rate at 2.5%. This is again a stronger than expected jobs data that drove prices down and resulted in a spike in the US dollar as well. So as you can see here, you see it's a nice uptrend. This is the earnings per share graphic. So ultimately, it's higher earnings that will drive the higher stock prices. As the S&P 500 earnings per share EPS estimate continue to rise, we should expect to see higher stock prices. So currently, the S&P 500 forward 12-month EPS estimate at $266.63. So this is the estimated earnings per share. And as long as it goes up, the stock market should go up. You see, this is the calendar year 2025 EPS that are projected to be at 276.84. It's another 15% higher than the calendar year 2024 estimate per share earnings at $240. So you see, it's an uptrend to 40, 265, 276, 311. Year 2022, 23, 24, 25 and 26. So keep going higher. So here we see that the S&P 500 actually here does seem to be getting slightly ahead of itself. So the forward 12-month PE ratio of the S&P 500 is 21.6% now. This is above the 5 years average of 19.5 and above the 10-year average of 18. So right now we can say that the stock market, yes, it's not expensive, but it's not cheap either. It's like above fair value. So again, it doesn't seem to be overvalued, but the overall market does seem to be overvalued, but there are still many high quality stocks that are undervalued. And as an investor, I highly encourage you to find those, to find buying opportunities. But you see, this is the P ratio. All the average investor always look only at the P ratio when evaluating the stock market. Yes, again, it's over the fair value, so can be read as expensive, but there are again so many buyers opportunities out there. At the same time, it's also important to remember that a higher projected earning growth does justify a higher price to earning multiple. So while the market current P ratio looks high relative to the last 10 years average P ratio, the EPS, or earning per share growth, is also much higher today, driven primarily by the big tech stock. So everything goes hands in hands. It's higher, but also the price per earning shares is higher. So what we use to have a knowledgeable understanding on the market, the PEG ratio. The PEG ratio is the P ratio divided by the 5-year projected earning per share growth. And this is the result, the graphic here in this highlight. So the market, as we see, it does not look as expensive in a PEG ratio. So as of September 26, the S&P 500 PEG ratio, it's at 1.2, far below the previous high of 1.6 and 2%. So PEG ratio actually tells us that we are not expensive at all. So in the chart below, you can see the return of the S&P 500 from 2020 till today, and we have a 109%. And compared to the Singapore stock. Why I'm showing you this chart? Because obviously you have to compare also the weakening and strengthening of the US dollar compared to other markets. So for example, if you see here in the next chart, you see the S&P 500 versus the index of currency of 10 years for the Singapore stocks. And even with the adjusted rate of US dollar strengthening or weakening, if you would have invested in those 10 years in the Singapore market, even with a stronger Singapore currency, you would have earned much less than adjusting for a 109% of earnings in the S&P 500 in America. Because you see, we have a 250% gain in 10 years, but adjusting the currency rate, you would go down to 109%. But still, you would have earned much more than in another currency. So for example, when you look at the USD against the Singapore dollar long-term chart, you can see that a fair range, it's between 1.28% to a high of 1.44. So at this now, we are trending to the lower part of the range. So I'm just giving you some Forex tips as well. So for example, now it's time to take advantage of the US dollar and buy more the US dollar, because obviously we are trading at the low of the range and technically should go up. Okay, so now one of the biggest news in the recent weeks was the China stock market bull run. And the big question is, China stock market bull run will last or will not last? So let's have a look at some of the indexes. So the Hang Seng Index Daily year to date, you see there is this huge spike up. In one day, they had the biggest gain in 16 years time frame in one day, where the Hang Seng Index earned over 34% in the past 2 weeks alone. So bringing the year-to-date return to 33.47%. So both indexes has entered in a bull market, and bull market is defined when you have a close of 20% or higher compared to above recent market lows. So this sudden reversal, I think we reached the bottom, hopefully we reached the bottom, but this sudden reversal sentiment was triggered by who? By the Chinese government. They did something unprecedented from decades. they want really to stimulate the stock market in China, and they did three things. Interest cut rates, so basically what they did in America, so they lower interest rates. Then they do easing of mortgage requirements, so basically they facilitate for first-time owner to get mortgages. They have much less strict requirement, and also much less strict requirement for businesses to loan money from banks. So they want to do that because there are areas in China where the real estate are tanking, the real estate prices are falling, are melting, and they just want home buyer to purchase so they can bring prices up. And same for business owner. And the third one, the central bank is funding equity purchases and share buyback. So the government allocated 114 billion to support stock purchases by institutional investors such as a pension fund, insurance company, and also they are lending money to companies to buy back their own shares. Obviously there is an interest rate for that. But this is something unprecedented. They really want to do whatever it takes to bring the stock market back up. But before investor gets too excited about the start of the new bull market in China, let's remember that the last two bull markets, the one in 2020 and the one in 2023, did not last even for a year. So this could be the third attempt or could be different. This will last. So it all depends if the government, the Chinese government, will follow through on their commitments to support the growth of the economy. If they follow through, yes, this could be a multi-year bull market for the Chinese stock. But what's interesting in the bull market is that some even prominent hedge fund managers like David Tepper are starting the overweight China equities in this new bull market. There have also been some other unprecedented rush among retail investors to open other brokerage accounts. This was something not seen in the previous rally. So many people are rushing back to buy China stock, from hedge fund to retailers, simple retailers like us. So this could actually be the real bull market. Could. So let me show you here some charts about some Chinese stock market that I'm personally holding, like BABA, that I'm holding from years for a huge loss. But for example, the intrinsic value, and let's note that the intrinsic value will change over time. The intrinsic value I calculated now for BABA is 136, and now we are at 114, so we are on the way to fair value. I'm planning to sell my share when we go slightly above fair value. There are other Chinese stocks like JD, Pinggan Insurance, and so on and so forth. But let's see actually here the PE ratio of the Hang Seng Index. So the Hong Kong Hang Seng Index now is trading at a PE ratio of 11.97%. So this is just the 10-year average is 11.68. So we are little above the 10 years average. And that's why, by the way, I sold my ASHR stock, which basically tracks the Hang Seng Index, simply because I see that we are slightly above fair value and I just would unload my position. So this is the Chinese stock market. Let's see the mainland CSI 300 index, which is now trading at 15x, which is one standard deviation above the 10-year average. So this one is also above the 10-year average, and that's why again I decided to exit my ASHR ETF, because I want to reduce my overall exposure in China stocks. So you can make smart guesses here. So the Chinese stock is actually a bit overvalued now. So should investors buy in China stock now? So this graphic will show you what's the nominal GDP rate of a country and how actually it returns into equity returns in the stock market of their country. So you can see here that, for example, the GDP of US at little above 4% translate in much higher return in equities, and this probably actually is the only market in the world where this happens, because you see in India the GDP is super high and the equity returns are super high as well, but still below the nominal GDP. For example, in China the GDP it's so much higher, but it just returns into negative equity returns. So that's why in the long run, I don't really believe in China stocks anymore. The US market as always ultimately overtakes all the other market, and that's where I feel I want to continue my investing, because when it comes to investing, the predictability of the future revenue and the earnings growth, I mean, this is what more important for me. I don't like uncertain business. Yes, in China you can do huge gain in a very short period of time, but it's so unpredictable that you can get also huge loss. So my take, I stick with monopolistic competitive advantages. Company like Amazon, Microsoft, Google, MasterCard, Nvidia, and they will still keep investing in the S&P 500. My bet on China was a bet. Yes, they are rebounding. It will be probably having a great return. But in the future, I am simply not planning on investing a lot in China anymore. To summarize, these are the catalysts and structural drivers that should drive stock prices to go higher. So one is the Fed starts their monetary easing cycle with resilient economy. Two, rising earning per share growth estimate for 2025 and 26 that we talked about before. And three, the China bazooka stimulus policy to boost global GDP growth. Then we have the fourth one, post-US election bull run. Usually post-US election there is a bull run. And the fifth, which is the one I trust and believe the most, there is a lot of cash on the sidelines. There are $6.4 trillion in money market funds balances still sitting there and ready to be deployed in the equity markets. So, and let's start talking about real estate now. As I always say, you can't fully understand real estate if you don't understand finance first, and that's why I'm giving you the breakdown of the finance highlight before the real estate. So, as we can see, I mean, real estate is ready for a rebound. There are lower interest rates. It's ready for a rebound, giving more buyers opportunity to get mortgages, and so more sellers also opportunity to sell. So despite there was a slower pace compared to last year, the market continued to show sign of signed contract resiliency. For example, properties between the 10 and $20 million has been particularly strong. We signed contract up to 11.1%, and properties over 20 million surging 16.17% over year on year. So we see that the average price is 1.9, the median price is 1.1, average price per square footage in a condo is 1,454. So we are at 4.8% year over year higher. There is a 27% shares of inventory over the 3 million. Usually there is a 7% average discount, and 10% of properties took less than 30 days to enter into contract. But 32% of properties took over 180 days to enter into contract, so over 6 months over the listing agreement of every agent. So the absorption rate is slower. Here you can see some graph about average discount, median price, year on year, average price. I mean, you will have all of these in the newsletter I'm going to be sending you very soon. We have differences between condo on top and co-op under. There is an average discount on co-op about 5% for the 1 bedroom and studio, 7% for the 2 bedroom, 13% for the 4 bedroom. So obviously the larger the unit, the more discount they have. Average price per square footage is around $1,000 to $1,300 per square feet in condo, and much higher for the condo, for co-op, and much higher for condo between 1.3 to almost 2,500, over 2,500 a square foot for the high-end condo and larger unit. Here again you can see the graphic. You will have all of these in the newsletter. You see also the historic price trend below. Co-op average by price, contract signed by point. Again, co-op by location, unit type, 1 bedroom, 2 bedroom studio, Upper East Side, Upper West, Midtown East. Again, here we have more and more and more, and you will have all of these in the newsletter that I will be going to send you now. So please subscribe to the channel if you want to have updates and you want to be the first one to know. Contact the Emanuele Fiore team if you have real estate needs or for any other free consultation. We are here to help you. And enjoy October, and ciao from the Emanuele Fiore team. Bye.